Okay, let's see how this tool works. Okay, we're practicing T accounts. And it's important to know that a T account looks like this here. It's a virtual T. It's a shortened down representation of an account. So in this case, it's the cash account, it's an asset account, as a debit and credit side. So what I want you to do is anticipate what side of this account it increases on, what side does it decrease on. I think the most important thing is to focus on what side it increases on, and then what the normal balance is. So in this case, cash being an asset, and fundamentally adhering to our dead mnemonic, that assets increase on the debit side, we see that it does in fact increase on the debit side. So therefore it's going to decrease on the credit side, and the normal balance will be a debit. What about revenue? Is that part of debt? No. So it increases on the credit side, decreases on the debit, and it will have a normal credit balance. Retained earnings. This one's a tricky one. Retained earnings isn't part of debt, so therefore it does increase on the credit side. But why does it increase on the credit side? Because revenues are eventually closed into retained earnings, giving it a credit entry. If a business consistently has net income, then it means it's had higher revenues than expenses over its life. It will have a natural normal credit balance, and that would be an indication of profitability of this company. Decreases on the debit side. You'll learn in chapter 3 how this account gets used. Normal balance is a credit. What about accounts payable? What type of an account is that? Liability? Correct. Is that part of debt? No. Increases on the credit side, decreases on the debit. Normal balance is credit. Equipment. Equipment is an asset. Functions just like any other asset, cash or otherwise. Increase on the debit, decrease on the credit, and it's a normal balance is on the debit side. Common stock, not part of debt, must increase on the credit side. Now, common stock usually has its own account. If you're a corporation, you will always have one class of stock, and that stock will be common. You can have multiple classifications of stock. We'll learn that in chapter 10. And it decreases on the debit side. Normal balance is on the credit. As you can see, the normal balance is always on the side in which it increases. AR, asset, debit, credit, normal balance. Land, asset, debit, credit, normal balance. Expenses, part of debt, right? Increases on the debit side, decreases on the credit, and we expect our expenses to have a normal debit balance. Again, that debit balance gets closed out to retained earnings, and we learned that in chapter 3. Supplies, asset, debit, credit, normal balance. Dividends, dividends is part of debt. Increases on debit, decreases credit, and normal balance is a debit, always. And again, this gets closed out to retained earnings as well. All these accounts that get closed out, revenues, expenses, and dividends, they're called the red accounts, and they are temporary accounts. They only accumulate amounts throughout the course of the year, and then they're all closed out and made zero again at the beginning of the new year. Hope that helped. Realizing that you can go back over this PowerPoint and practice it more than one time. Just remember debt, and you will live on.